Despite its declining stock price and worries over shrinking requests, Tesla and its investors may be in for a significant surprise, particularly in terms of the company's stock price. Following the company's difficult year, which was marked by a steep stock collapse that saw shares plummet by around 70%, several stock experts have revised their price projections and profit estimates for Tesla stock. Concerns over Elon Musk's acquisition of Twitter and the global economic crisis prompted this move. However, not everyone believes that Tesla's price will keep falling. In fact, some analysts, such as Edward Jones, believe that this is the best time to buy more Tesla shares. The financial institution recently upgraded its rating of Tesla stock from hold to buy, stating that the company's leadership in EVs gives it a clear advantage over rivals. Everyone, welcome back to Tesla Tomorrow, the American financial services firm. Edward Jones has upgraded its rating for Tesla stock to a buy. It's interesting to note that they argue that the share price does not fairly represent Tesla's long-term development potential, and that the manufacturer will be able to capitalize on the expanding EV market thanks to its impending product releases. Edward Jones offers company owners retirement and college savings plans, mutual assets, stocks, and securities, as well as wealth management services. It offers investment services to clients in the US and Canada through a branch network of more than 15,000 locations and 19,000 financial advisors. Apart from overseeing around $1.7 trillion in assets under administration, the company currently has relationships with nearly 8 million customers. Funding is typically solely allocated to individual investors and entrepreneurs. In 2019, Edward Jones's revenue was roughly $8.50 billion, with more than 15,000 locations in North America. Edward Jones has more branch offices than any other financial company in the U.S. The company's growth has been impressive. Its annual revenue has grown from over $16 million in 1977 to roughly $12.3 billion now. Investors shouldn't discount the fact that a company like this encourages the purchase of Tesla stock. So why have they changed their rating for Tesla stock? Let's look into it. But before we do, if you like this kind of stuff, don't forget to like and subscribe so you can keep up with all of Tesla's news. In 2021, Edward Jones analyst Jeff Window began recommending Tesla as a hold. He claims that despite the entry of new rivals, Tesla's then $800 billion market capitalization already factored in a significant amount of long-term growth, as well as notable accomplishments and forays outside the automobile industry, making it the clear leader in the global market for electric vehicles. He claimed that the market was factoring in an average yearly increase in profits of 30 to 40% over the following 10 years, which would call for the successful creation and launch of products like affordable cars, semi-trucks, and driverless cars. Window went on to say that Tesla could only maintain its high valuation at the moment if the global EV market continued to grow rapidly. This was also true a few years ago, and the corporation now appears to be even more hopeful about Tesla. In a recent message to customers, the firm's analysis elevated Tesla from hold to buy and added the stock to its core list. Despite economic difficulties, the report pointed out that global emissions and mileage regulations are driving the growth of EVs. It also believes that, in spite of escalating competition, Tesla will continue to have a significant presence in foreign markets. According to corporate analyst Jeff Window, the price movement this year has been attractive. However, the success of Tesla's latest initiatives and its prospects of maintaining a significant EV market share ultimately depend on investor mood. Tesla stock has been under pressure due to worries about Elon Musk's frequent sales of the company's stock and his disregard for the automaker. However, Window replies that he is not very concerned about his divided attention because Tesla's top leadership team has the expertise to effectively run the company going forward. He continued by saying that Musk will need to set important objectives, which are essential for the EV manufacturer's long-term growth. According to him, Tesla still has excellent prospects for 2023, which is sufficient to upgrade the company's recommendation from hold to buy. Despite concerns about slowing economic growth and Musk's time spent operating Twitter, causing the stock price to plummet last year, software programs with recurring subscriptions, like full self-driving, are especially important for Tesla since they are expected to increase profitability. Tesla is also working to reduce costs and boost production effectiveness. Continuous improvements in battery design, in particular, should reduce costs and boost profitability. According to Window, The company's share price does not fairly represent its prospects for long-term growth, and Tesla will be able to take advantage of this expanding market by launching new products. Several other Edward Jones appraisals have also stated that Tesla will benefit greatly by distancing itself from Twitter. Despite having a competent management team that can execute its current operational tasks given how swiftly their company is growing, Tesla is probably going to continue to dominate the EV market and play a major role in a dramatic increase in sales. I admit that CEO Cathie Wood recently tweeted about Hertz, an American auto rental firm that asserted that its electric vehicles had maintenance costs that were more than 50% lower than those of internal combustion engines. The rise is breaking all demand estimates faster than expected, she adds, and electric cars have more miles driven. Cathie Wood predicts that as more people transition to electric vehicles, the need for oil will decrease in the future. The market for EVs is growing at a rapid pace, and it is becoming clear that more people will be driving them in the years to come, she said. The Tesla bull also believes that the potential shift to battery-powered automobiles will probably propel the EV market. The market is expected to have increased from $187.36 billion in 2021 to $1,318.2 billion by 2028 and beyond. This will surpass the decrease caused by the pandemic in 2020, according to the head of ARK Invest. 2022 to 2024 will be the ideal time frame for electric vehicle sales. After the new EV model is unveiled, government policies will be more supportive of it. According to related news, New York recently announced that it will install 350 new chargers across the city and swap out roughly 925 internal combustion engine vehicles. With more than 1,000 electric vehicles in the public government fleet, both costs will be covered by federal funds. This is in addition to the round for $120 million for EVs and associated infrastructure that was approved at the end of 2021. EVs are in great demand right now, and more will follow. So what will happen if Tesla releases a less costly EV? Maybe one that costs $20,000 or $30,000 if the car maker is able to capitalize on this requirement. The outcomes could be noteworthy. Buyers of EVs are likely to choose a Tesla over another EV due to its lower price and higher efficiency. When discussing Tesla's new products, Window brought up the impending rollout of Cybertrucks in Texas and the potential release of a revised Model 3 later this year. He believes that both vehicles will improve Tesla's value and position in the stock market. This year, there will also be more competition in the EV sector. Even though Tesla won't be the first company to deliver an electric truck, the Cybertruck is predicted to be one of the most anticipated vehicles ever, with over 1.5 million pre-orders. The semi-truck should be expected as a stimulus as well. Despite the fact that Tesla stock is currently well behind expectations, there is still reason for optimism, especially considering the company's plans to launch several new products this year. As noted by Window in 2021, funding its expansion plans is a major challenge that Tesla may face over the next decade. He stated that if funding becomes an issue in the future, it would put Tesla's growth trajectory in jeopardy. However, Tesla was not considered an investment-grade firm at the time. This time, we should expect better results because things have changed. The recent investment-grade designation of Tesla may have caused Edward Jones to update its rating. However, Tesla maintains a significant share of the market despite new competitors entering the market. But it's not only about EVs, it's also about Tesla's recent forays into solar and energy storage technologies. There are several other ongoing projects, like the humanoid robot and the robo-taxi. Do investors still need to believe in Tesla stock? In the comments box below, let us know how much you believe Tesla is worth. To find out more about Tesla's recent activities, feel free to click on the next video that shows up on your screen. See you there.